Let's go through and take a look on the board, and we'll discuss the primary mortgage market. And again, some of the players in the primary mortgage market, we're talking about folks like thrifts and savings and commercial banks, insurance companies. We're talking about credit unions and endowment funds, mortgage banking companies, and mortgage brokers. So let me kind of show you, what's at stake. In the previous section that we were talking about, we were learning about the lien theory versus the title theory. We were talking about the mortgage or the mortgagee. In this section, what do we have? We've got that same single-family residence. So I'm going to say SFR, single-family residence. We still have that owner-occupied property. I'm going to write OO here. And we still have a loan made to a consumer with good income, good asset, good credit, and good employment. Now, going back to that old slide, we have a bank. And this particular bank makes a loan to a consumer. So the consumer gets a loan. And the consumer gives a mortgage. So here, this is the mortgage. So we've got a mortgage being given to the bank. We've got a loan being given to a consumer. And remember, that loan was $100,000. This transaction made up between the bank and the consumer produced two documents. And we talked about those and we defined what the covenants inside of one of the mortgages were. We looked at the mortgage and the promissory note. So inside of these two things, these two in concert make up what they call one whole loan. So one whole loan transaction was made up of the mortgage and the note. And traditionally what would happen with these items is these two documents, once signed over, would be given to the bank, and the bank would place these two particular documents inside of their vault. Okay, let's pretend that that's a vault. I'm a really bad artist. So here's a vault. The documents would be stored in the vault, and these would be long-term performing assets. All right? And the bank would collect over time the principal and the interest repayment over the time of loan. And traditional banking is still played out very much this way, and this is what that happens to be. Now, in this market, before we even had a secondary market, this would be the standard banking. This is a standard loan transaction with a whole loan. Inside of this particular item as well, we have another player in the world of the primary mortgage market. This party here, this is known as the mortgage broker. Now, the mortgage broker acts as an intermediary between a consumer and a lender, and it works with the lender's wholesale division. And what they do, in fact, in wholesale is they have a specific department that works with third-party vendors. These third-party vendors, known as mortgage brokers, have to be duly licensed in the state in which they originate loans in. And what they do is they arrange mortgage loans. They do not make loans, or they do not issue commitments. So it's important to note a couple of things here. Number one, a mortgage broker does not issue commitments. They are simply an intermediary. They arrange loans. As a matter of fact, most banking commissions across the country require the mortgage broker to prominently advertise that they do, in fact, arrange loans and they do not make them. What that also does is it limits what a mortgage broker can do. A mortgage broker can actually assist a consumer in applying for a mortgage, and what they can also do is they can help them by pre-qualifying an applicant. A lender can pre-approve. So a pre-approval is issued by a lender, and an approval is issued by a lender for a loan commitment. A mortgage broker arranges mortgage loans and acts as an intermediary between a consumer and a bank, working with the bank's wholesale division. Now, depending on the size of the broker and the volume that they originate, there are lots of pricing concessions that the wholesale division might be able to offer. So in fact, some people might think it might be a little bit more expensive working with the broker. And what I'm going to tell you is there's a good possibility, depending on the broker and the relationship and the amount of volume that they actually originate, that you might actually be able to get a better rate and better terms than if you walked into a bank at their retail point versus working through their wholesale division. So you might want to contemplate working with a local broker. And they tend to do their trade craft pretty well. So, it might be a very effective professional that you work with in the business. Now, when we come back, we're going to continue our exploration in the primary mortgage market.